Here's something most real estate investors don't realize until years later. Seller financing isn't just for people who can't get traditional loans. It's one of the most powerful wealth building tools in real estate. And once you understand how to actually use it, you'll see deals nobody else is competing for. By the end of this video, you'll know 3 specific strategies that let you buy properties with little to no money down, using the seller's own money instead of a bank's. And the third strategy? It's the one most investors completely overlook, and it can let you control a property worth $500,000 without ever qualifying for a mortgage. So grab something to drink and let's dig in. First, let's make sure we're all talking about the same thing. Seller financing means the property owner acts as the bank. Instead of going to a lender, you negotiate directly with the seller and they carry the note. You make your down payment, then send them monthly payments just like you would a mortgage. The seller doesn't hand you a loan out of the goodness of their heart. They're usually highly motivated to sell and willing to accept installment payments because it lets them defer capital gains taxes, collect interest, and often unload a property they can't sell any other way. Here's the first strategy. It's called the assuming strategy, and it's the easiest entry point for beginners. Some properties come with existing financing that can be assumed by the next buyer. That means you take over their mortgage payments. The loan stays in their name, but you make the payments. The key is finding properties where the existing loan has a due on sale clause that the lender won't aggressively enforce. A friend of mine in Phoenix named Marcus used this in 2022. He found a distressed duplex listed for $210,000. The owner owed $160,000 on an existing FHA loan. Marcus negotiated a $30,000 down payment directly to the seller, then started making the $1,200 monthly payments. He didn't need a bank. He didn't need perfect credit. He needed $30,000 and a willing seller. Within 18 months, Marcus had refinanced into a conventional loan in his own name. The property now generates $2,800 monthly in gross rent. His out-of-pocket cost beyond the down payment was basically zero beyond normal repairs. The lesson here is simple. Sellers with existing financing often don't realize their loan can be assumed. You find those properties, negotiate the terms, and you win. But here's where it gets really interesting. Most people think seller financing only works when the seller owns the property free and clear. That's actually not true, and it's the assumption that keeps most investors from ever using this strategy. Strategy number 2 is called wraparound financing, and it's significantly more powerful. The seller still carries the existing mortgage, but they wrap that loan into a new loan they create for you. You make payments to them. They use part of your payment to cover their existing mortgage. You never interact with their lender at all. Let me make this concrete with numbers. Say a seller has a property worth $400,000. They still owe $250,000 on it at 4% interest. You negotiate a purchase price of $380,000. You put down $50,000. The seller carries a note for the remaining $330,000 at 6% interest for 15 years. From your perspective, you're getting a $380,000 property, putting $50,000 down, and financing $330,000 at 6%. From the seller's perspective, they're getting their $50,000 in equity out. They just created a $330,000 investment yielding 6%, and their own mortgage payment only costs them roughly $1,200 per month on the $250,000 balance. They might be collecting $1,500 monthly from you while only paying $1,200 to their lender. That's positive cash flow for them on day one. Wraparound financing works especially well when interest rates have risen since the seller got their original loan. A seller who locked in a 3% mortgage in 2020 is sitting on a 4% or 5% loan today. They can carry a note at 6% and still be below market rates. Everyone wins. If this is clicking for you, hit that subscribe button. I put out videos like this every single week, and there's something even better coming up next. Now, for the third strategy, I want to tell you about a woman in Tampa named Diane who did something most real estate experts said was impossible. She bought a 6-unit apartment building using almost no money down. The building was listed at $475,000. The owner had owned it for 30 years, was retiring, and hadn't updated the financing in over a decade. He had a balloon payment coming due in 9 months and no way to refinance because his income had dropped after retirement. Diane structured what she called a sandwich lease with option to buy. Here's how it worked. She leased the building for 2 years at $3,500 per month. That was above the current market rent, but she negotiated the right to sublet all 6 units at market rate. The existing tenants were paying below market anyway. She immediately raised rents on 4 of the 6 units. That created $400 in monthly cash flow above her lease payment. More importantly, she included an option to purchase clause in the lease. The purchase price was locked at $475,000. She had 2 years to put together the financing. During those 2 years, she documented the rent increases, improved the building's net operating income by over $18,000 annually, and refinanced into a conventional loan based on the improved numbers. She closed on the building 18 months into the lease. Her initial cash outlay was only the first month's lease payment of $3,500 plus a small option fee of $5,000. Total cash at risk before closing was under $10,000. She now owns a $475,000 asset, generating over $1,200 monthly in positive cash flow. That approach, the sandwich lease with option to buy, is the one most investors completely overlook. Here's why it's so powerful. You control the property before you ever have to qualify for financing. You're buying time to improve the numbers, fix the credit, or build a relationship with a private lender. And the seller usually loves it because they get a qualified tenant with skin in the game who is motivated to close. The risk is that you're paying rent on a property you might not buy. But if you structure the lease terms right and do your due diligence upfront, that risk is manageable. And the upside is completely disproportionate to the risk. So here's what you should take away from this. Assuming existing financing works when sellers have motivated reasons to deal directly with you. Wraparound financing works when sellers have below market existing loans and want to defer taxes while generating passive income. And the sandwich lease with option to buy works when you need time to arrange financing or improve a property's fundamentals before you can close. The common thread is that none of these strategies require perfect credit, massive down payments, or a bank's approval. They require one thing above all else: negotiating directly with motivated sellers. The moment you learn how to find motivated sellers and structure deals that work for both sides, you unlock access to real estate opportunities that most investors never see. If this video helped you see real estate differently, give it a like and share it with someone who's been trying to break into investing without a huge pile of cash. Subscribe if you haven't already. Next week, I'm breaking down exactly how to find motivated sellers in any market using nothing but free tools and a few phone calls. See you then.